February 6th, 2024. Today, we essentially got a measured move down of this opening range, and we had something interesting happen today, which was there was no breakout of the 18 bar range. It's pretty unusual to not get a breakout of the 18 bar range, only happens about 10% of the time. So, once every couple weeks, maybe something like this happens. So, it's better to usually bet on there being a breakout of the 18 bar range, but today just was one of those days where we weren't quite able to get it. Bar one is a bull bar with big tails on the top, but really not all that good. We did have a gap up, so gap up plus follow through on the bull bar. But I mentioned yesterday that I thought we might have to get back to this close because this was a reasonable buy the close bar. And you can see when we did, we ended up finding sellers. Why? Because bulls, they bought the close, they were disappointed in this. And this is probably a trading range, so they needed to get let out around break even. Inside bar two, it's a high one, but a bear body, so really not as good as it could be. I think bulls will probably wait to buy. Good bull bar on three, but look at the placement. It's right near yesterday's high. And look at yesterday. It's an inside bar and a big bear bar. So it's really not all that good of a buy above yesterday's high. So do you want to be buying an individual bull bar near yesterday's high? Probably not. I think that, if you're buying up here, you're probably going to be expecting bad follow through. And I think it's just really not a great buy. Disappointment on four, which is relatively expected for the bulls who bought above three. You'll notice that even if three wasn't a good buy at all, you could maybe argue it was theoretically reasonable, but it really wasn't a solid buy at all. But even the bulls who bought the close of three were let out around break even during bar 79, and that's a big piece of trading range days is the magnets get tested all the time and gaps close constantly. Big tail below four, so not a good buy, not a good sell. We're probably high in a trading range, but I don't think any bear wants to sell below four. It's essentially two legs up. Bad follow through for the bears on five, a big tail on the bottom. So again, really not all that ideal to be selling down here. You could argue, some bears some bulls they bought and they tried to scale them lower and then get out around break even. They were disappointed. They were buying below four, hoping to get a bull bar and a third push up, but instead they got this disappointing bar with a big tail, thinking they're going to get a second leg down. And so all those bulls sold out of their longs, and that caused the big bear bar on six. Six, a bear bar closing near its low. It's a strong bar, and it's probably enough for a second leg down. We're probably always in short, but I think we're getting low in what's probably a developing trading range. So I don't think that selling down here is all that great of an idea. You could sell six, but I think you're just going to be expecting disappointing follow through. You get kind of disappointing follow through on seven. It's not, it's bad, but it's not the worst thing in the world to get a bar like bar seven. You can see though what was happening down here, right? Traders sold below six and they scalped out with exactly 5 points. So they sell below six, they get filled on seven, scalp out with 5 points, thinking it's going to be a trading range day. Why are they scalping out thinking it's going to be, or if they think it's going to be a trading range day, but it's still always in short, why are they scalping out? Well, my theory was that they could see that the bulls got trapped below bar one and they hadn't been let out around break even yet. And they didn't get let out all the way until over here. But my theory, you could see there was even a one tick gap here. So bears had one more attempt down, but they failed and then we closed the gap. So my theory was the bears thought that the limit order bulls who bought below here were going to end up making money. So they were more interested in exiting their shorts with a scalp. You can see any bear, some bears sold six and they said, okay, well, I'll hold through a full bar on seven, but then they get that bar on seven. And you can see it's also right at yesterday's close where bears are buying back shorts. So they're thinking, well, probably actually not all that great. So they start buying back shorts on seven, and then you get eight, bear bar goes back down to that exact same price where those bears were buying back shorts and they exit again. So why? Again, on eight, traders, they see, let me back up. Traders scalped out with 5.7, some on seven, some held hoping that we were going to get a really strong close on seven. They were disappointed at seven, and so they scalped out with 5 points during eight. So you can see traders scalping out with a couple points. Bear bar on nine, but tail on the bottom, tails on these bars. This really probably isn't all that good. It is always in short, and we have 6 straight bear closes, but it looks more like a leg in a trading range to me. The big bull bar on 10. Fairly, disappointing for the bears. And this is kind of what can happen, though, is the problem. When you start to rally on 10, bears notice that other traders are covering buying back their shorts. And then other traders will also start buying back their shorts, thinking that, if we're going to start to rally here, we might get all the way back to this gap. And in trading ranges, risk happens fast. So a bar like 10 can easily get bigger than this and get all the way up here. So if you're short down here, you have to be able to make really quick decisions. You can't just be getting out all the way up here or above a bull bar, because the bar could be all the way up here. You probably have to get out a point or so above 9. 11, a big bear bar. It's a low one short for the bears in a bear trend, but the bar got too big. I think the reality is the bears who are selling down here are probably going to get bad follow through, and they're probably going to get trapped. So I don't think it's all that good of a sell below 11. You're also selling right where bears who sold the close of 9 got trapped on 10. So they might be looking to get out as well. So I don't think that that selling 11 is all that good. If it was a smaller bar somewhere up here, it might be a more credible swing, smaller risk and better risk reward. But I think the bar just got too big, and now you're selling the bottom of a tight trading range. 12, a reversal up. It's a wedge. 1, 2, 3. So I thought, okay, buy on 12, but probably more of a minor reversal. I think that well, there's a couple things. When you see 12, you're thinking the gap with the one low is going to close. That was my first thought was, well, I think the gap with the one low will probably close. And the bar is disappointing, the tail is disappointing, but trading ranges tend to be disappointing. Sometimes with signal bars. So it's probably an okay buy, but the follow through might be kind of limited. Follow through for the bulls on 13, but it's good enough bull bar, but I just think in general, if you want a big swing, you want a better bull bar. I thought we would get to the one low, but you can see what did traders do? They bought above 12, and then you needed to get to 4966.5 in order for them to make 5 points. Where's the high of this bar? 4966.75. So bulls bought above 12, but they scalped with 5 points. Rather than waiting to get to the one low, they just exited with 5 points. So traders exiting disappointed causes the big tail on 14. And a lot of bulls see 14 and they'll just dump out of their lungs on the close of 14, disappointed, thinking that the pullback could be fairly deep and they don't want to be a part of it. Bear bar on 15, but you can see there was probably buyers below 14. So I think, most of the selling on 15 was probably just bulls dumping their longs, being disappointed and taking the 1 or 2 points that they got, since they had basically no true risk. So bear bar, but big tail on the bottom, probably sellers above, probably buyers not too far below. And then reversal down 16, we got sellers above. If you sell 16, well, bear argument is you could argue one of two things: spike and then two-legged pullback, and then a bear bar closing near its low. And you still have this open gap, which is good for the bears. Additionally, 1, 2, 3, so a wedge, but you could argue the wedge is failing and you're going to get a breakup to the downside. But I think either one of those arguments. So if you're selling below 16, it's a swing trade. And, if you're selling, this as a two-legged pullback, what are you looking for? You're probably looking for a measured move down. So if you're looking to get all the way down here, I think it's okay to wait and just see if 16 gets follow through on 17. You can see that it doesn't. I mean, it's clearly, it's very suspicious looking open. It could definitely be a trading range open. It probably is a trading range open. So I don't think you really need to be selling here. It is 3 pushes too. And if you're looking for a measured move with a wedge down, then you're going to have so much time to get in. So there's not really a whole bunch of reasons to sell below 16. It's probably an okay swing, but it just seems unnecessary. Reversal up 17. Bears might exit, but you're right on a flat moving average now. So now you have to be extremely careful about doing anything. You're right on a flat moving average. Don't really want to be trading too much. Disappointing follow through 18, but it's a double top with, 16, but it's really not that good. To me, this is just a tight trading range. Bad follow through 19. And then a big bull bar 20. Doesn't quite close the gap with the one low. Bulls were hoping we were going to get all the way back to here, but you can see some of the bulls were so eager to get out that they just sold out with a small loss. And then you get 21, but 21 was disappointing as well. Bears were hoping for a really strong close, and then they could sell for maybe a measured move down of the wedge or a measured move down of this trading range. And instead, they get a disappointing follow-through bar, 21, since 20 was technically the signal bar. So a lot of those traders just buy back their shorts around break even, and that causes the bull bar 22. Can you buy above 22? I suppose you probably can. The problem I have with it is you're buying high in this tight trading range. You know that, at this point in the day, you think 90% chance we're going to break out of the 18 bar range. We might do it to the upside, but it's really not all that ideal to be buying 22 because you're buying very high in this trading range. And you know that probably at the one low, there's going to be sellers. So you can take the buy above 22, I think, but you have to be relatively quick to make decisions. You get followed through on 23 and, it's bull follow through and it's a bull bar, but again, it's just not ideal. There's, a tail on the bottom. It's a smaller bar. So it's really just not what you want. If you bought above 22, you want another bar that looks exactly like 22. You want to be really convinced we're going higher, and 23 just doesn't do that. To me, when I see 23, I think the bulls need one more bar, and they don't get it. 24. It's not surprising that they don't get it, because usually in a trading range, when you need one more bar, you're not going to get it. And you can see the traders don't get it 24, and then you get disappointment bar 25. What's causing 25? Well, the bulls bought the close 23. Maybe they're scaling in lower. They're hoping we're going to get a rally, but they know we probably won't. So they're selling out disappointed during 25. A lot of traders will exit below 25, and so maybe reasonable swing sell below 25. You can follow through 26, follow through 27, probably sell the close by 27. Not as much sell below, but sell the close, hoping for a breakout of the 18 bar range. Bears, they have 4 straight bear bars here, so they're more winning with time than they are necessarily with price. But I think any bulls who are buying here are going to be really disappointed and probably be expecting to be stopped out. So I think okay to sell the close of 27, and if you get a bull reversal bar, you just get out. Big follow through for the Bears 28. A lot of them start to take profits, causing 29, and you get a low one short 30, maybe a reasonable swing sell. But if you're selling right at the bottom of a trading range. And if we're going to go down, again, you're going to have a lot of time to get in, so it's really probably not as great as it could be. Disappointing follow through on 31, and an inside bar doji 32. So again, really not excellent. Some follow through for the Bears 33, but signal bar 32, not that good. To me, this just looks like a tight trading range. It's a channel too, so maybe spike, channel, but what happens after a spike and channel? A trading range, and we're at the bottom of a trading range. So you're hoping for a breakout below the channel, essentially, if you're a bear here, which isn't super high probability. Bull bar, so 34, probably sellers above 33. You notice we didn't go above the channel line. So bears, essentially, I thought at this point, had really one more chance here on 35. They needed some sort of bear bar, probably closing below its midpoint, probably closing below 34 at least, just give the bears some sort of momentum to the downside, and they just couldn't get it. So essentially what happened, what's 36? Why is 36 so big? It's bears giving up, right? It's the same concept that you're talking about over here, where bears just start covering shorts, realizing other bears are going to cover shorts. And that's what causes such a big bull bar on 36. 36, I wouldn't personally buy it. I think you're now buying too high in a trading range. So it's better to buy a pullback of the bar. And we get a deep pullback 37. And you can see traders more willing to buy around the 35 high, where bears got trapped because they know bears will be buying back shorts as well. 38 inside bar, so it's an II pattern, 37, 38. So it's theoretically a buy above 38, but you're buying in the middle of a tight trade, or a middle of an overall trading range right now. Today's been a trading range day so far, and it's probably going to continue to be that. So I really don't think 38 is a very good buy. And if you do buy 38 and you see 39, are you excited about 39? Does that really make you, super excited? No, not really. The bulls probably need one more bar, and therefore they're probably not going to get it. It's a really small follow through bar. So a lot of times what will happen is traders are just going to exit. It's also the moving average is really flat. So really not all that great to be doing anything right now. And then disappointing follow through 40, because the bears or the bulls saw 39, not that good. They exited their longs, and that causes 40. Traders more interested in buying below 37 or 38 than they were buying above it. Disappointment for the bears on 41, because no one really left to take the sell. 42, a doji bar. It's an II again, but probably going to get some sort of failed breakout here. Really not good to be doing anything. This is just a tight trading range. Bull bar 43, but you're again at the top of this range. And what happened at this price last time? Bulls sold. So again, really not that great to be buying 43. And you have to be thinking, what's going to happen if you get disappointing follow through for 43, right? So we had buy above 38, disappointing follow through 39, and then what happened? Bulls exited. Buy above 43, disappointing follow through 44. So what do you think is going to happen? Bulls are going to exit, and that's what happens, causing 45. So it's, this I think is the same concept as this, bulls exiting. 46, a doji bar. You can see the bulls who bought below 44 scaled in lower, made money. And another II, 47 or 46, 47, but we've gotten so many failed breakouts of IIs at this point that I don't think anything's all that good. A bull bar on 48, and we've had 3 pushes sideways, so some bulls would argue big bull bar 36, 1, pullback 2, pullback 3. So 3 push pullback, and then hopefully another leg up for the bulls, maybe to the open of the day, which this ends up just being a vacuum test of the open of the day. But I don't really love buying 48 either. I think you're still buying high in a trading range, and it's still pretty sketchy. You're definitely buying the top of a tight trading range. So it's really, it's the best buy of the three for sure. I think 48 is the best buy between, 38, 43, and 48, but I still don't think it's super ideal to be buying up here. You want to look for buys in the lower part of the range. Follow through for the Bulls 49, but a tail on the top. More follow through 50, 51, but doji bar and, good bull bar 50, but really tail top, tail bottom, and disappointment 49. So not as good as it could be. Bull bar 50, but a tail on the bottom. Or sorry, 51, but tail on the bottom. And then follow through for the Bulls 52. But look where you are. You're right at the open of the day, and it's a trading range day. And the open of the day is always a magnet on trading range days, usually where traders sell. So some traders sold, causing 52. A second leg up for the Bulls, 53. So 52, pullback, and then second leg up from this, 53. You can see a lot of the Bulls were going to exit if we traded below 53. So Bulls bought the close of it and didn't let it trigger, causing 54. But traders end up giving up above 54, and then you get disappointment 55. Why are they giving up? Well, I thought that Bulls in general were hoping we were going to get some sort of micro channel and then get, a little bit more of a parabolic move and a breakout of the 18 bar range. But when you get a disappointing bar like 53 closing on its low, a lot of traders will be looking to exit, and a lot of Bulls instead bought the close 51 or 52, hoping we were going to continue to rally, disappointed in 53, and saw 54 as a gift to get out break even. And that's why you get 55 outside down. And then you get, the remainder of the Bulls who held through that bar are just disappointed with 55, and they exit their longs, causing 56. It's probably always in short, and you get more follow through 57, but always in short at the bottom of a trading range, really not what you want. You remember, this is a trading range day, so it's, it's like opposite day, right? When the market becomes clearly always in long, or so let's say, market becomes always in short down here and then starts to reverse. Markets might be always in long up here, but then reverses. Might be always in long here, probably always in long here, at least I would say, maybe by 50 or 49, 50. And then, not much profit and reverses. So when it becomes always in short at the bottom of the range, what do you think is going to happen? Probably disappointment. So good follow through for the Bears 57, but probably going to get disappointing follow through soon, which you do on 58, and traders give up above it, causing 59. Inside bar 60 and second leg up 61. So 1, pullback 2. And then essentially low 1 short below 61, triggers 62, but not all that good. Bull bar 63. 1 pullback, 2 pullback, 3. So I think you could argue, some traders would argue essentially failed two-legged correction. So spike, two-legged correction, and a low 1 or low 2 attempt, depending how you look at it. And so that's a failure and a buy above 63, looking for a measured move up somewhere up here, which is about what we got. I also thought the 54 low, Bulls bought below the 54 low. Well, it wasn't a great buy. It was reasonable. So I thought that those traders who scaled in would probably be let out. So an okay buy of, probably the best trade of the day, to be honest, for a stop order. I thought 63 was probably the best trade of the day. And you get follow through 64, disappointment 65. And you can see we got close to the 54 low during 66, but traders, so disappointed with how this played out that they're exiting a little bit below break even. And then a doji bar 67 usually means the buy the close rally is coming to an end soon. Bull bar 68, but a big tail on the top. You can see, we're just testing the open of the day. The top of the 18 bar range, I think, is too far away to think about at this point. And then an inside bar 69 and another doji. So 2 dojis and 3 bars and a bar with a big tail. Past 4 bars, 2 dojis. I suppose past 5 bars, 3 dojis and 2 big tails. So not what you want. So Eddie Bulls, who bought the close 69, disappointed 70, probably scaled in. And you can see they're getting out around the close of 69 during 71. 72, disappointment for any bears who are looking to sell. But really, this should get a second leg up, but not, the pullback could be fairly deep. It's exactly what it was, a 2-legged correction, but relatively deep and a steep enough micro channel that we're probably not going that much higher. We do get a bull surprise at the end of the day, but I would probably leave this alone, that alone. I would say the last, buy above 63, get out at the 54 low or the open of the day. That's probably the last reasonable thing to do. Or if you hold, maybe get out below 71. On the daily chart, a surprisingly small day. An inside bar, or sorry, not an inside bar, but a failed breakout of yesterday's high. You can see if you bought above this, how are you feeling about this? Disappointed. I've been saying, I think we're going to get a deeper pullback. I don't think we're going all that much higher. I don't know how far the pullback's going to be, but I do think we're going to get a pullback. On the weekly chart, so far, disappointment. We haven't quite overlapped with this high yet. You can see we came close, but we didn't getting there. So it's still technically an open gap with this high, but I wouldn't be surprised at all if we closed it. And yeah, that's the day.